Good morning. I am John Kosar from Asbury Research and Asbury Investment Management. Welcome to your Daily 5. The first chart is a simple daily chart of the S&P 500 going back a few months. I call it the game board. That's what our Asbury Research subscribers know it as. It gives you a chance to kind of game your investing out in advance and not so much have to wait for the markets every move, but say, here we are. Here's the trend, here's the internals, here's where we might be going, and it allows you to put scenarios in your head as to where you want to get in or get out or add. So here's where we are right now. On our charts, the 200-day moving average is always orange and the 50-day is always blue. The 200-day is a widely watched major trend proxy that you can't really watch CNBC or Fox Business more than 5 minutes without somebody mentioning. And so we like to watch those as just a general indication of what the trend is. And you can see we're above both of those trends. The most important one of those is the 200-day. And despite what's going on in the world right now, we are back above it. We have been for about a week. Making it even more important, I think, is the market likes big fat numbers because they're easy to remember. 3,000 is effectively where the 200-day is. Actually, it's 3,004. So everyone's watching S&P 3,000 to see if we can stay above it, and we are too. So again, despite the fact that we're in the middle of global pandemic and there's 40 million people unemployed in the US and there's corporate bankruptcies and the whole thing, everything we see on TV, the market's the market, and for whatever reason, the market wants to go higher right now. Where to next? 3137 is the March 3rd high. That's only about a little less than 1% above the market as I'm looking across the room at our screens. And then 3215 is the January 31st low. That is about 3.5% higher than the market. So those are the next two steps on the game board, so to speak, going higher. And underneath, the 200-day moving average is more an area to me than it is an absolute level. So I'm also looking at 2955, which is here in green. Support is green, resistance is red. April 29th high. So I lump these two together. Look at basically 3,000 to 2950 as the level that if we are indeed resuming the secular uptrend that started back in 2009, this is the level that should now be the base for that, and it should be the support for that. Number two, now that we've seen the game board, we want to know which way we're going. And for that, I use market internals. We have a couple of in-house models here that are tactical models, and they tell us what the day-to-day condition of the market is so we know maybe what to expect. 10 years ago, certainly 20 years ago, I think you could look at the S&P 500 by itself day to day and get a pretty good representation of what's going on in the market. Not so much anymore. I think a lot of that has to do with a lot more computer-driven trading. There's a lot of algos that jerk the market up and down during the day, tends to force investors to be selling when they should be buying and buying when they should be selling. So we put some models together for that. One is a correction protection model, which we're not going to talk about today. And the other one's the Asbury 6. Asbury 6 is very transparent. There are 6 market metrics that we look at every day, and these are published on our website every day. The only one of them that is based on price alone is the rate of change in the S&P 500. You can see that's been positive since May 14th of 2020. And then there's relative performance of stocks versus high yield bonds. There's investor asset flows, corporate bond spreads, trading value, market breadth. We look at these every day. So these have been positive since April the 9th. 4 or more green are necessary to be positive. Prior to that, they were negative or red since February the 24th. So so market internals are positive. So that tells us in terms of the game board, we should be looking higher and not lower. Follow the leaders. I like to watch big cap stocks that are linear, that have a very tight linear correlation to the S&P 500 and tend to lead, especially when the market's doing something what I would call unusual, like roaring higher in the face of a global pandemic. One of those is Apple. So here's a chart of Apple, and you can see it's bumping up against its all-time high. The S&P 500 is not testing its all-time high yet. It just cleared the 200-day moving average. Apple is testing its all-time high from back in late January. 327.85 is the price. So I'm watching this like a hawk because the linear correlation between Apple and the S&P 500 and both of the NASDAQ indexes is extremely tight and stable going back 30 or 40 years. If Apple can get above 327.85 and hold it and continue to move higher, that looks like the tip of the spear for the market, the broad market going higher. If it has trouble here, and this turns south, per the correlation, this could be one of the catalysts that causes some kind of a pullback in the S&P 500. So again, this is one that's really on our watch list for this week. Volatility. It's a trigger for us, especially in, again, an atypical period now when you're saying, well, yeah, the market's higher, I'm not sure if it's sustainable. So what we have here up top on the top panel is the VIX going back to March. It's a daily version of the VIX, along with its 21-day moving average. In blue here, why the 21-day? Because that's our tactical time period here at Asbury Research. S&P 500 daily bar chart underneath, just for perspective. The VIX fell below its 21-day moving average on March 31st. That was just when the SPX was coming off the canvas on its low that it made on March the 23rd. Then the VIX has been riding the 21-day all the way down, and each time that it kissed it, April 21st, May 4th, May 14th, those were all little near-term bottoms in the S&P 500. The 21-day is at 29.83 right now. As long as we stay under it, the waters are calm, the market can continue to go higher. If it starts moving above it, that's going to be a key for me to start to turn over rocks to see if I can find other reasons that we might be having a bearish reversal in the S&P 500. Finally, relative performance. So what do you do with this information? What part of the market should you be in? One thing that we're looking at here that makes a lot of sense to me is the Dow. What we have here is the relative performance daily of the Dow 30 versus the S&P 500 going back to 2014. And underneath it, we've got a 63-day momentum metric that we're looking at here. And the significance of this is when the Dow gets at a quarterly oversold extreme versus SPX, which are all these green vertical arrows here, they tend to be periods where you get some kind of a rebound from the Dow, some kind of outperformance from the Dow over the SPX. You could see in June 2014, big one here in August of 2015, big period of outperformance for the Dow versus SPX. Here's June of 2018, and now we see it again. Why does this matter? Because this might be a way to have your cake and eat it too. If you're nervous about being long the market here, if you're nervous about pushing a lot of chips into the game just when we just edged up above the 200-day moving average, but we're still in the midst of all this turmoil in the world, maybe buying the Dow instead of the S&P 500. The Dow tends to outperform the S&P 500 when the market is uncertain or if it's weak. So by buying the Dow here instead of SPX, even if the market turns lower, we should see some outperformance from the Dow. Obviously, if the market turns down, everything is going to turn down. Apple's going to turn down. All the indexes will turn down to various degrees. But according to this chart and according to historic precedents, you should see the Dow be able to do a little bit better, hold up a little bit better than the S&P 500. So there you have it. There's your Daily 5. Thanks for watching. We'll see you next time.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.